So good afternoon. As Ross mentioned, my name is Kurt Baker. I have the Edward Jones office here in town. Edward Jones is a financial firm that specializes in helping the individual investor save for their financial goals. We're based in St. Louis. There are about 19,000 different financial advisors in every state and province in Canada. So as you travel around, you'll see lots of offices like ours. They're in small towns like Lynn, and they're in the big cities. We've got an office in Harlem and Manhattan now, in New York City. So we're everywhere. So what I want to do is just kind of give you two very, very life-changing pieces of information. I was going to say advice, but you get talked to by older folks all the time, and so advice, I don't know if that'll go over if it'll register or not, but two very life-changing pieces of information. First is investing is very simple. So if you go online and you read about how to invest, and there's rabbit holes you can go down that will make it incredibly complicated, but investing is very simple, and you should keep it simple. And two is that the best time to get started is now. And I'm going to touch on how investing is simple now, and I'm going to finish on the best time to get invested is now, because as you saw in the headline of the email and the ad, so you want to be a millionaire. I want to show you how you can be a millionaire. One very big piece of information is you are young, you are very wealthy in time. You may not be wealthy in money, but you're very wealthy in time. Older folks, like, let's talk about Elon Musk, the inventor of Tesla, is about my age. He is the wealthiest man on this planet in dollars, but not necessarily in time. You are much wealthier than him in time. And what I mean by that is the power of compound investing, compounding interest, compounding dividends. You've got time for your money, much more time for your money to grow as compared to someone like Elon Musk. Now, he's got it, he's got the money, but you've got the time, and there's not enough money in this world to bring him from age 50 to 20. So keep that in mind. So investing is very simple. So if you do have questions, please think of them, write them down. As I mentioned, we'll try to leave time for answers at the end. I can stick around. I live here in Lynn. I can stick around afterwards if you have more questions. But write those, if you're taking notes, write those two pieces of information down. Investing is simple, and then you're very wealthy in time. The best time, or you can write down, the best time to start investing is now. So investing is simple. What I want to talk about, and I apologize for not having a big fancy computerized PowerPoint presentation. I'm kind of old school. I have my presentation that I've kind of created myself years ago. I've stuck with it. It makes sense to me. And I think hopefully it'll make sense to you on down the road. So in the investing world, there's lots of things you can do. As I mentioned, if you go online and start looking around, you can go down rabbit holes that'll just boggle your mind. But I like to compare the investment world to driving on a 5-lane highway. So there's no 5-lane highways around here, but I-270 in St. Louis is 5-lane. I've counted it. It frustrates me very much driving on it. But you get on a highway, and just as on any highway, as you travel, if you move to the left lane, the farther left you move is the fast lane, the passing lane. So in the investing world, I can't call it the passing lane or the fast lane, but risk increases as you move this way. You get on the road because you have a goal. And so in my presentation, the goal I've used is you want to get to the Cardinals game. So you're here in Lynn, Missouri, and you want to get to the Cardinals game. In the investing world, you'll have a goal. What I'm going to talk about is retirement, but it may be saving for a house. It may be saving for a car. It may be saving for a wedding. It may be saving for I don't know what. It might just be saving. And it's okay not to have a goal. It's okay to say, I just want to save. And that's okay. But for purposes of this, I want to have a goal, and the goal is going to be retirement. Now, please, please, please don't think I'm talking about retirement as old, fat, white-haired sitting in a rocking chair. I'm talking about financial independence. So that could be 65, but it could be 50. It could be 45, it could be 40. Money does not buy happiness, but it does buy options. And so the more money you have, the quicker you can decide, do I want to stop working 40 hours a week at age 67? Do I want to stop working 40 hours a week at age 47?
Age 30.
At age 30, fantastic. So the more money you have in your back pocket, the quicker that decision comes. So that's what I mean by retirement. I don't mean old and not working anymore. I mean financial independence. So I'm going to use this, and I apologize if you can't quite see it over there, but it's the best I can do, and someday I'll transpose this to a PowerPoint presentation. But the first lane, and I'm going to exaggerate, but the right lane when you're driving is typically the slower lane, and in the investment world, that's cash. So cash is the most, I don't want to say safe investment, but it's one that fluctuates the least amount. So if you're driving in this lane, you're driving 10 to 20 miles an hour. This is the green dollar bills in your wallet. It is your checking account. It's a savings account. At Edward Jones, we call that money market, or we used to. But it's money that you're not taking any risk with. And right now, you're probably not earning any interest on it whatsoever. I think our money market is paying 1/100th of 1%, 0.01, which is ridiculous, but that's a whole nother presentation as to why that's happening. But if you're in this lane, you're saving this. It's very safe. You're not going to lose it. The green dollar bills in your wallet, you can fold it over, put it in a jar, bury it in your backyard. 10 years from now, you can dig it up. If you're in Lynn, you can go down to Thriftway, and you can still buy some products with it, buy what you need with it, as long as there's a federal government backing up that dollar bill, that $100 bill. The problem is inflation. Inflation is cost of goods rising. So you all may not have experienced that or noticed that so much in your life, but talk to your parents. They have. I can remember when a stamp cost 20 cents. I believe it's 55 cents now. I can remember going to basketball games as a kid and buying a 10-ounce bottle of soda at the basketball games for $0.25. That sounds ridiculous. You can't even buy a 10-ounce bottle anymore. It's 32 ounces or 16, 24 ounces. But what I mean is the cost of goods rising. And so that's something you're fighting. So if you're burying your money in your backyard and digging it up 10 years later, you've lost purchasing power very safely. Inflation historically runs about 3%. So that means in about 25 years, the cost of everything doubles. It's not a good thing or a bad thing. That's just the way it is. And if you want to talk about why that is, that's a whole nother presentation. So in this lane, if you're driving 15 miles an hour between here and St. Louis, will you make it to the game in time? No, you're not going to make it. You're not going to have enough time. If you're driving 15 miles an hour in this lane, from here to St. Louis, will you wreck your car? No, you're not going to wreck your car. So in the investment world, if you're only investing in this lane, will you reach your retirement goal or your house saving goal or whatever it is? No, you're not going to reach it. Will you lose it all? Absolutely not. As long as there's a federal government around, those dollars are worth something. So this is not investing, this is savings. So this is money you're not taking any risk with. So some people say, well, that sounds great, Kurt, but I want my money to grow. So they're the ones that's going to drive 30 to 50 miles an hour. And this is income investing. This is bonds, CDs, and mutual funds made up of CDs, funds made up of CDs and bonds. So this is something earning an interest rate. So you may not, people don't talk about CDs so much anymore. That's a certificate of deposit. But what that is you're making a loan to the bank for a certain time frame for a certain amount. So I like simple math, so I'm going to use $10,000. And I like the good old days, so I'm going to say you're going to get a 3% CD. You can't get that right now. But if you walked into any of the banks in town, there's 2 of them, and you said, I want to buy a 1-year CD, they'll say, sure, for 1 year we'll pay you 3%. So 3% for 1 year. So on January 27th, 2022, you could walk in there and get your money back, and you would have $10,300. Does that make sense? So you loaned them your money for a year. They paid you 3%, very safe. CDs are FDIC insured, Federal Depository Insurance Corporation. So it's insured, meaning if the bank goes under, the federal government will guarantee you'll get your money back. So it's a very safe investment, meaning you know what you're going to get when you're going to get it. A bond works the very same way as a CD. A CD is typically 3 months to 5 years in length. A bond is typically 5 years to 30 years in length. So because of the time frame, being longer, you're going to get paid better. So a bond, a few years ago, a 30-year bond might have paid 5 or 6%, whereas, as I mentioned, the CD paid 3%. So you're going to get paid better, but you're tying your money up a lot longer. A bond is something issued by an entity like State Tech. State Tech wants to build a beautiful new building out here, so they can, if they want to spend $10 million to do it, they can either go to a bank and borrow it, or they can issue bonds to you and I through companies like Edward Jones. And what we do as investment firms is we break it up into $5,000 increments, and our clients buy those bonds. And so State Tech borrows money from the public and pays them that interest rate, that 3 to 5% interest rate over a 5 to 30-year period. So it's not a great place for all your money, but it's a great place for some of your money if you have enough to do that. So the income investment lane is a very safe way to invest, and it is investing. It's not saving, that's investing, because you're tying your money up for a lot longer period. So in the real world, if you're driving, say, 40 miles an hour between here and St. Louis, will you make it to the Cardinals game in time? Yeah, you might, but you may not get the parking lot you want. You may not see batting practice. You may not get your nachos and hot dog before the game starts, that sort of thing. If you're driving 40 miles an hour between here and St. Louis, will you wreck your car? No, probably not. You're going slow enough, you'll see that deer before it jumps out, you'll be able to avoid it. So in the real world, in the investment world, if you're only investing in this lane, will you reach your goal? Yeah, you might. It may not quite be what you had in mind, but you might do it. Will you wreck your car? Will you lose it all? Will you lose a portion of it? No, probably not. CDs are FDIC insured. As long as there's a federal government, you're going to get your money back. Bonds are backed by the issuer. So if you buy a bond issued by State Tech, you'll probably get it back. State Tech's probably going to be here. So it's a pretty good, safe investment. As I mentioned, 3 to 5%. Inflation's running 3%. So you're keeping pace with inflation. So you're not building purchasing power. Does that make sense? So you have to take on a little more risk. And this is people that are going to be driving the speed limit, 55 to 70 miles an hour. And this is growth and income. This is stocks and funds made up of these investments. So growth and income is my favorite category, and this is the meat and potatoes of investing. So growth and income, if you're investing in stocks, you're going to own a company. So the way that stock investing works is companies split their ownership up into millions of pieces of pie. And I meant to look to see what the stock price of Walmart was before I got here, but let's just say it's $100 a share. I have no idea. But if you really like Walmart, you shop at Walmart, you buy everything from food to clothes there. If you really like Walmart, you can't just walk into that Walmart on the east end of Jeff City and say, hey, I think I'm going to buy this place. It's pretty cool. Because you don't have enough money. But what you may be able to do if you have a fictitious $100 bill, for $100, you could buy one share of the company. You could walk into my office, plunk down $100. And again, I'm not saying Walmart's trading at $100 a share. I don't know what it is off the top of my head. But for $100, you could buy one piece. So Walmart splits its ownership up into millions and millions of pieces of pie. But you don't have to get the Waltons or the Cronkies or the Lorry's permission. You can buy a share. And as an owner of Walmart, you can sit at the same table, though, as the Waltons and the Lories and the Cronkies, the ownership of Walmart. The Walton family started Walmart. So you can sit at the same table of them because you're an owner of the company. So as an owner of the company, you're entitled to a copy of their financials. You're entitled to an invitation to their annual meeting. They have annual meetings once a year in Bentonville. And most importantly, you get a portion of their profit. So Walmart is going to pay you somewhere around $2.50 for every share that you own. Walmart split their ownership up into those millions of pieces of pie called shares in 1971. They began paying a dividend because they were profitable in 1971. They shared their profit with you in the form of dividends beginning in 1971, and they have raised that dividend every year since 1971. So that's a very good investment because it provides income and rising income, because Walmart's share price does go up, but more importantly, their profit has increased every year since 1971, and so that allows them to share increased profit with you every year. So most people take that dividend that they're paid and buy more shares with it. Not everybody, but a lot of people do. But a lot of retirees that are living off their money will take that income, and that's their spending money. But if you do the math, $2.50 divided by $100, that's a 2.5% yield on your money. As I mentioned, CDs right now are paying less than 0.1% for 1 year. So just the income alone is a great investment, a great income level. But we want the share price to go up. Now, the share price can do three things. The share price of any company can do three things. It can go up, it can go down, or it can stay the same. So let's talk about that. Why does it go down? That's what everybody gets scared about. The stock market is nothing more than a glorified auction. If there's more buyers than sellers, the price goes up. And so if there are some people interested in what's being sold, if there's more than two of them, or if there's at least two of them bidding against each other, it doesn't matter the value of what's being sold, it just goes up because two people want it. And so whoever wants it bad enough gets it. That's how an auction works. Stock market's the same way. Every day there's some people that are offering their shares for sale and people looking to buy them. And if there's more demand than there is supply, that means the stock price is going to go from 100 to 150. So what causes that? What causes people to want to buy the stock? Well, increased profits, higher number of stores. People go into the stores and they look around and they see it's a clean, nice, inviting place to be. So just more interest causes more people to want to buy the stock. Now the flip side is, I just described why it went up. Why it goes down is if there's more sellers than buyers. So people that get worried about why stock prices drop, it goes down if there's more sellers than buyers. And why does that happen? If profits are declining, if stores are not well run, not well managed, if stores are closing, if there's a lot of bad news, the stock price goes down. So that's all there is to it. So remember I said at the beginning of this, investing is very simple. So you want to look for companies that you know of. If you're getting started investing and you want to invest in individual stocks, you want to think of companies you know of, like Walmart, like Caterpillar or Cummins or John Deere. As I look around and see some logos, I see a Caterpillar, I see a Under Armour. Unfortunately, I get this question a lot. Carhartt is not publicly traded. I wish it was. But think about companies you own and then start looking. One of the things you will need to look at is it profitable and is it increasing its profits? If it's increasing its profits, and you can Google that information, if it's increasing its profits, that's a good sign. That doesn't mean it's a good buy, but it's a good sign. So that's what a stock is. Now, mutual funds, there are mutual funds and exchange-traded funds that you can buy that are groups of stocks. So every fund has its own goal, and there are growth and income funds. And what those are baskets of stocks. So there are money managers that put together dividend-paying stocks, and what they do is they'll decide, should we buy Walmart or should we buy Target? Should we buy Caterpillar or should we buy John Deere? Should we buy Coke or should we buy Pepsi? And so on and so forth. They may decide to buy both. They may decide that, now's a great time to buy Walmart and Target. They may decide that, hey, the construction building is booming, we need to buy Caterpillar and John Deere, and so on and so forth. But the important part is, in a fund, whether that be an exchange-traded fund or a mutual fund, you're going to own about 100 different companies. That way you don't have to decide which is best, and the money managers decide, they do that for you. There's a little bit of expense involved, but they do that for you. The greatest part about that is, if one of these companies goes under, so if Walmart goes under, which I doubt it will, but it's happened, Kmart went under, Sears went under, Radio Shack went under, but typically there's about 100 companies in a fund. If one of them goes under, well, then you own 99. So did it kill you? No, it's not. You didn't lose everything. It might have hurt a little bit, but you still own 99 other companies. Whereas if you owned Walmart solely and every dime that you had was in Walmart and it went under, you lost it all. So that's kind of how a fund works. There's mutual funds, which there are money managers that come to work every day and they pick and choose which funds that go in there. And then there's something called an exchange-traded fund, where there's money managers that come to work and all they do is set parameters about what can be in the fund. So they set parameters like it's got to be profitable, it's got to have increased profits, it's got to be so big, and then whatever fits all of those parameters is what's in that fund. So there's subtle differences between the two, but they're both very popular ways to invest. So in the real world, if you're driving 60 miles, 65 miles an hour between here and St. Louis, will you meet your goal? Will you get to the game? Absolutely. Will you wreck your car? Probably not. There's hundreds of thousands, if not millions, of people that drive every day to speed limit and do that just fine. But it does happen. So in the investment world, if you're investing solely in growth and income, will you reach your goal? Yep, I can confidently say you will. Will you wreck your car, so to speak? Will you lose it at some point? Honestly, I can't say that you won't. It will go up and down in value depending on how our economy works. So some people say, well, Kurt, I've got big goals, huge goals. So I got to do better than that. So those are the ones that are on the interstate driving 75 to 85 miles an hour, and that's growth investment. That's stocks again, and funds. Growth investing is investing in small and mid-sized companies. So you can own shares of small companies and you can own shares of mid-sized companies. Under Armour is a mid-sized company. Compared to Nike, it's tiny. A small company would be like Stanley Black & Decker. So there are some companies that we've heard of that we would consider small companies, and there's lots of companies that we've never heard of that are going to fit this category. But small companies want to grow and become mid-sized. Mid-sized companies want to grow and become large. As that works, you make a ton of money. So there's more risk here, though, because a small company can only handle so many down quarters in a row, meaning they can only lose money for so long and they're gone, out of business, so you lose it all. Whereas a large company can handle that for years sometimes. So they fluctuate in value a lot more. So when their highs are high, they're really high. When their lows are low, they're really low. So they fluctuate in value a lot more. But when they do well, they do really well. So we want to have some of that. So if you're driving 80 miles an hour between here and St. Louis, will you make the game? Yep, you'll make it. Will you wreck your car? Yeah, you might. In the investment world, if you're investing solely in this lane, will you reach your goals? Yeah, you'll get there. Will you wreck your car, so to speak? Will you lose it at some point? Yeah, you might. It's going to be a bumpy ride. So then there's some people that say, okay, Kurt, but I want to make money fast. And those are the ones when you're driving along the interstate and you don't even see them and all of a sudden they fly by you. That's the aggressive. That's stocks, funds, but also real estate, commodities, and more recently, cryptocurrency. Probably heard of Bitcoin. But aggressive can be a lot of things. At Edward Jones, our favorite aggressive investment is something invested in emerging markets. Emerging markets are companies located in or doing business in India, China, Africa, South America, Eastern Europe, including Russia. The reason why we like those areas is there's 3 billion people in those regions. Here in the United States, roughly speaking, there's 300 million of us. So for every one of us, there's 10 of those individuals. And all they want is to have a standard of living somewhere close to what we have. As they do that, the companies they do business with make money. So they're typically micro companies, is what we call that. And they go in and out of business all the time. So that's what we consider aggressive. That's one of the first things if you walk into an Edward Jones office and get an aggressive investment, that's what you'll see. But commodities are aggressive. Real estate is a commodity. That's aggressive because you have to find a piece of real estate that you like and can afford. You have to pay the taxes on it. You have to pay the insurance on it. You have to keep it up, meaning if it's around here, you have to keep it cleared or in pasture or find a renter or whatever. And then when you want to sell it, you have to find somebody that's willing to pay the price that you want to sell it at. And you have to pay the closing costs and all that. So you just never know if that's going to happen, when it's going to happen, how it's going to happen. But land, real estate is a good investment. Commodities like oil and gold, silver, corn, cotton, cattle, the whole 9 yards are the same thing. If you grow up on a farm, you take your cattle to the market, you're going to get whatever price is there. I mean, you can look it up in the paper and see what market price is for cattle, but you may not get that price unless there's a lot of buyers there. If there's a lot of buyers, you're going to get that price or maybe more, who knows? But you're a price taker. You're going to get the price that you get, and that's all. You don't have any choice of it. So commodities fall into that category. Bitcoin falls into that category. I don't know if you've heard of Bitcoin or not, but I get a lot of questions about it. Bitcoin is an electronic cryptocurrency that's created by computers. Frankly, I don't know how long it'll be around because it seems like a great way to launder money. Governments can't tax it, and no government regulates it. So I view that as a huge risk. So lots of risky investments up here. So in the real world, if you're driving 90 miles an hour, 100 miles an hour to St. Louis, will you get to the game in time? Absolutely. Will you wreck your car? It's a matter of time if you're driving that fast. If you're only investing in this lane in the investment world, will you reach your goal? Absolutely. Will you lose a big, huge chunk of it at some point? It's only a matter of time. Commodities do strange things, and emerging market companies do strange things sometimes. There's lots of outside risks there. So that's kind of the different levels and categories of investment. And again, investment is very simple, and I like to make it simple and keep it simple. In the real world, you have to pick one of these lanes to drive in to get to your goal. In the investment world, though, you don't have to do that, thankfully. So what I like to do is build a diversified portfolio, maybe about 2 or 3% in cash, maybe about 18 to 20% in income investments, maybe about 60% in growth and income investments, maybe about 15% in growth, and about 5% in aggressive. Of course, everybody's portfolio is built tailored to their individual needs, but we can spread it out and spread the risk into different areas, and we can increase it at certain times and decrease it at certain times depending on what's going on with the markets. But basically, in a nutshell, that is my simple world of inflation, or of investing. If inflation's running 3%, what I would recommend is if you're doing a long-term investment for retirement or something like that, if you built a portfolio similar to this, you would probably expect a 6 to 8% average annual return. Inflation's running at 3%, so you're doubling to tripling the rate of inflation, and that's how you build purchasing power. So not only do you want your money to grow, but you want to gain purchasing power. So, and the last thing I'll say on that is, if you think of the people that you know of, you don't have to personally know them, but if you think of the people you know of that you consider truly wealthy, they all have something in common in that they own things. They own land, they own stocks, they own businesses. And so, again, you may not be wealthy enough to go in and buy a business, but you can certainly buy some stocks. You can buy some mutual funds. So when you come and talk to a financial advisor, I'm going to touch on that a little bit, and then I'll close with the whole part about you being wealthy and now's the best time to invest. When you come talk to a financial advisor, always be willing to share with them what your goals are. I can only help you enough if I know I can only go on the information you're telling me. So you want to share your goals with them of why you're doing this. And again, it's okay to say, I don't know, I just want to save. But you always want to ask a lot of questions. You know, what am I investing in? For me here in Lynn, it's very, very extremely important for me to know I want my clients to know what they're invested in and why. I want them to know that because at some point the value is going to go down. 3 out of every 10 years, the stock market goes down. I want them to stay invested through those down years because that's a great way to build value if you're investing monthly and if you're reinvesting the dividends. When it goes down in value, you buy more shares when it's cheaper. My business is the only business that when prices go down, people run away. If prices go down at Thriftway, if prices go down at Walmart, if prices go down on Amazon, people want to buy. They like sales. But in my business, prices go down and people want to run away. It's backwards. So you want to ask questions. You want to tell them what your goals are, ask them why they're recommending what they're recommending. You want to ask what it costs. If the financial advisor that you're speaking with can't tell you how much it costs, if the financial advisor won't tell you what it costs, I'm not saying that they're bad, I'm just saying that's a big red flag. So don't be afraid to ask us, people like me, hey, what's this costing me? Expenses are a piece of knowledge. It's not the end all. If you go on the internet, you're going to hear about, you have to lower your expenses. Make sure you buy the cheapest expenses. Don't use a financial advisor. They just take your money. Expenses is a piece of data, but it's not the end all. For example, I'm sure people in your life have told you get what you pay for. I know Carhartt clothing is very expensive. So is Under Armour and Nike, but it's very good, right? I mean, that's why you buy it, because it's very, very good. It lasts a long time. It works. The zipper doesn't break. You don't get holes in it. It works. It lasts a long time. So you're willing to pay a little extra sometimes for higher quality. So just because something might be more expensive, a financial advisor might be more expensive, doesn't necessarily mean you're not going to get the growth that you want. So you want to make sure you can ask, what's this costing me? And again, make sure they tell you that, and if they don't or they won't, that's another piece of data. And so then you want to meet with that financial advisor. You want to be able to talk with them, either pick up a phone and call them, shoot them an email, or walk in their office. Because this is your money. This is very, very important. I don't care if you have $250 or $250,000. This is your money. This is very important to you. They should be good stewards of it, as it should you. So you want to make sure you ask good questions. What am I investing in? What are you recommending I invest in? How much does it cost me? How long do I stay invested in it? When do you think I'll reach my goal? And so at Edward Jones, we can give you a printout every time we meet. How close are we to reaching your goal? How close are we? How close are we? Because we want to make sure if you invest, if you have a goal without parameters, like an age or a time or an amount, it's not necessarily a goal, it's just a dream. And so you want to have parameters around it, and you want to share that with your financial advisor, and you want to be able to measure that every time you meet if you want to. The last thing I'll say before I move on is don't be afraid of down markets. The market goes up and down. That's just what it does. Our economy is cyclical. It's going to do that. I don't care who's in the White House. I don't care what the headlines are of the day. The market's going to go up or it's going to go down. When it goes up, that's great. That's what it's supposed to do, right? That's what you want. You want to see your statements going up in value. But when it goes down in value, people start questioning me, and that's great. But when it goes down in value, that's a signal to purchase, perhaps, because prices are cheaper. Things go on sale, and there's a stock that you want, and suddenly if it falls from $100 a share to $75 a share, that's a really good time to buy. It's a really good time to continue to reinvest dividends. More importantly, it's a very good time to continue your monthly investing.